Hello, everyone. Thank you for being here. What I'd like to do is tell you about an iron ore play in Quebec. This is a reduced version of our deck, our PowerPoint presentation that we have at our booth. I'm going to go fairly quickly, just point out some of the key points. And if you have any questions, please drop by. We'll be at our booth all day. So just a cautionary, forward-looking statement. We're located on the border of Quebec and Labrador. We're in the southern part of the trough. It's an area where the rocks have been recrystallized, the iron ore. This is where all the producers are in this area. And the reason for that is the geology, the rocks have been recrystallized, so it's coarser, easier to liberate the iron ore from the waste. It takes about 1/10 of the energy. And we're closest to the North Shore. We're in Sept-Îles, so there's a port that was just announced. These are some of the key variables to an iron ore industry that was really marginal for 30 to 40 years. It was $25, $30 a ton, both on the cost side and on the revenue stream, the price stream. So it was very marginal. Now with the exciting demand in China, when, to vulgarize it, it's about they're going to build a Canada a year for the next 15 years. It's going to take a lot of iron ore, it's going to take a lot of copper, et cetera. So now the price range, in our studies, we used 115, which is what we use for the 3-year moving average. The average is actually 132 to 135, and the spot price is hovering around 170. Came off a bit at the end of the year, around 140, but a far shot from 25 to 30. So it's unprecedented demand for iron ore, and the price range reflects that. So now everything is back in play. So I'm going to tell you about that. So we did our study November 21st. It was our second preliminary economic assessment. We tripled the value and the mine life. We're now at a 25-year financial model, but we have a 40-year mine life, so the recommendation by the engineers is to double production. So the way you got to look at it is if you have 500 million tons, you have enough for one line of production for 20 years, and that NPV is $4 billion, right here, at an 8% discounted rate, with the rate of return of 41.5% and a payback period of 2.3 years. That's a very robust economic model. So just remember, that goes with about 500 million tons. So we're in an established iron ore district. We're surrounded by mines. The permitting is known. Working with the First Nations, we're very, very close to them. And so everything is coming together, and there's going to be a big boom. This trough produced 33 million tons for 30 to 40 years. We can see about 200 million tons coming out of the trough over the next 5 to 10. So the backdrop of all this is the Quebec Plan Nord. There's a vision of $80 billion over 25 years. So it's quite an exciting backdrop. The government's enthused, the First Nations are enthused, everyone's enthused to get this going, and we can see it on the horizon. In Quebec, we have competitive power rates. Not only do we have 1/10 of the need of energy to separate the iron ore, but it's in a very low-cost energy sector. And we have a proven team. I'm going to tell you about some of the people that are with us, but the big point is Richard Canel of Consolidated Thompson. You might have heard of Consolidated Thompson. He's our senior technical advisor. He just built a mine located right there called Moire Lake. It was in production in 2010. He just proved the model was the first mine built since the 70s. He's working with us. So we have the team, we have the properties, and we have an unprecedented price range. So this is the capital structure. We just did a bought deal about a week ago for $30 million to get us through to feasibility. It'll close in March. We're covered by 11 firms, different institutional analysts, and of course the Kaufman brothers cover us as well. This is the team. Jean Despatie was the founding director of Consolidated Thompson. Here on the bottom, Richard Canel, he's our senior technical advisor, and their senior VP finance at Consolidated Thompson has also joined us as an advisor. And we have an extensive team of people that worked in exploration for the last 30 years. We have over 200 years experience at least. So this is some of I won't go through all of this, but we're in a favorable operating environment and our competitive advantages. I'm going to pick up the pace a bit here. This is the big thing with iron ore is infrastructure. So we got to take it out by the train. We can't take it out in trucks. We got to take it out by train. So this railway that goes right between all of our properties, because we're in this Fermont iron ore district, is owned by ArcelorMittal. So it's a private railway. There's a chance, but probably won't get access to that rail. So what we've done, and I'll show you on another slide, is to come down the QNSNL, which is a common carrier, and we're working on other solutions to make the transportation costs even better. I hope to be able to share that with you in the near future. The port down on the southern end, that's also booming. The federal government announced a 25% funding, about $55 million for a $220 million port that'll handle 50 million tons per year. They have a vision of 100 and more million tons. It'll probably by tonnage be the largest port in North America within the foreseeable future due to the iron ore boom. So the other thing is the power lines. We get our power from Churchill, and again, the power line goes right through the cluster. So infrastructure-wise, we're very close to everything, and we're closest to the North Shore. That's key. Up here, we also have another property of 310 square kilometers at Okanagan. Our partner is working on that. We still have a 49% interest. And I'm going to move on because there's lots to say. Again, the port down here is the new vision of the port that was just announced. And so there'll be, this is going into a build. We're going to start reserving land. We have 4 different options designed on where we want to be and what we want to do, so we'll be talking with them soon. This is kind of zoom into the camp. Again, when you look at this trough, the curve at the bottom here, that's just because it was impacted from the south. I'll show you a sample a little bit, see what that kicked it. It recrystallized it all, so it coarsened it, and that makes it easier to separate. This is the camp. Iron Ore Company of Canada produced 17 million tons. They're going to go to 30. They'd like to go to 50. Cliffs just bought Bloom Lake. That's why Richard was available. But Cliffs has been here for years, producing 3 million tons. They bought Bloom, and then they got these properties down here, and they have another 1 billion tons down there. So they have about 1 billion tons on their property. It sold last year for $5 billion, a year after it got in operation. ArcelorMittal is located here. They've been producing since the 60s. They used to produce down here at Gagnon. That's a mining town. That's why the rail goes in there. And then they supplemented feed from Fire Lake. Now Fire Lake is being mined, but it's being brought back up to Arcelor, just on the backhaul with empty trains and put through their mills. So in this area, you have the same material that could go right through the Arcelor mill. Now, why did Arcelor had that property? Why did they let it go? It's separated at 425 microns. So that's 0.4 millimeters. If we go further north up here, all the other iron ore plays, they separate at 45 microns, a tenth of Bloom Lake. And Arcelor and IOC, they liberate at 850, so twice that. So when you look at a taconite, this is 20 times coarser, what I'm talking about. Fire Lake North is our main play, and we have another exciting play here, Oil Can. It's only 6 kilometers away, so just within this, we have multi-billion ton potential, but we also outline 1 billion tons, close to 1 billion tons. Harvey-Tuttle at 717 at 25, it's 947 million tons at 23. O'Keefe-Purdy has huge potential, relatively untested. And we also have Bellechasse. That's where we started off because it was right by the road. We took the 100 million ton historical resource and doubled it. These things have not been touched since 40 years. They've been on the shelf, these projects. Only Moire was producing. So it's really exciting. Our first step was to get a large land package, and now it's paying off in spades. So this is just Fire Lake North. To give you an example, this one was tested to see if it was bigger than Moire. They said, no, it's thinner. So they let it go. It was 40 million tons historical. We just filed a 1 billion ton PEA in October. In November. The resource was in October. So now you can see the economics. We're producing more per annum for a line because the mills are getting a bit bigger and more horsepower, but also the coarseness, which you'll see here in a second. So again, the NPV, payback period, the resources, I'm going to move along here. This is just the design of the 3 pits, the waste dumps and the tailings. So the engineering studies are moving along quite quickly. This is what I wanted to get to. That's what I call spectacularite. Specular hematite, but because it's so coarse grain, I have a sample here. I had to hide it to come and do my talk. But this is the coarseness. You can see the grains. It's sand size, just below a millimeter, not 45 microns. So there's a difference here, and we see it in our energy costs and our grade. And the big point about this is it's clean. All the deleterious elements the steel mills want are low. So you use this as a diluter to dilute down some of the other ones. So it'll command a premium, but that'll benefit us down the road. This is the schedule. So we just finished our scoping study, feasibility study, 3rd quarter. We're going to go through our permitting. We have ideas on how to accelerate that. And then the construction period is here, production 2015. The port will come in right around here, Q1, so that's going to be 15 months ahead of us. So things are all lining up. So this is oil can. Fire Lake's the one I just told you about. Oil can is to the north. Look at this number, 545 meters at 33% iron. So if you take that, multiply by 0.7, the bench width to 350 meters, lots of room for big trucks and shovels. This is the footprint, and I have details out at the booth. That 545 is located down there. So there's lots of milestones coming up. This is in our deck. We're going to be very busy putting this together and getting ready for construction and feasibility, and a list of reasons why you should invest in our company. It's a great time for iron ore, and we're in the right place. Thanks.